In 2026, the most expensive thing you can own is not a Ferrari, a private jet, or a collection of rare watches. It is the 30-year fixed-rate mortgage on a modest three-bedroom house. We've been conditioned to believe that buying a home is the ultimate financial achievement, the bedrock of the American dream, and the only safe way to build generational wealth. Society tells you that renting is throwing money away, and that a mortgage is simply a forced savings account. This is a mathematical lie. In reality, the 30-year mortgage is a financial parasite designed by banks to ensure that by the time you actually own your home, you have paid for it 3 times over, and the bank has harvested the most productive decades of your life. Today, I'm going to prove to you with brutal, undeniable arithmetic that your house is not an investment, it is a debt transfer mechanism. We are going to expose the hidden architecture of amortization, the invisible tax of maintenance, and the staggering opportunity cost that is keeping you from ever achieving true sovereignty. You are not building an asset, you are funding a bank's executive bonus pool for the next 30 years, and I'm going to show you exactly how they've engineered the numbers to make you feel grateful for the privilege. The trap is set the moment you walk into the bank. It relies on a psychological phenomenon called payment sensitivity. The system knows that you don't care about the total cost. You only care if the monthly payment fits into your current paycheck. This is how they get you. They frame the debt in 360 small digestible bites, masking the fact that the first 10 to 15 years of those payments go almost exclusively toward interest. This is front-loaded interest, and it is the closest thing to legal theft that exists in the modern world. You fall for it because of the endowment effect, the idea that owning something physical makes you more secure. But you don't own it, the bank owns it. You are simply a glorified tenant who is also responsible for the plumbing, the taxes, and the insurance. The system was designed this way to keep the labor force immobile and compliant. It is much harder to quit a toxic job or start a business when you are tethered to a 30-year liability that demands tribute every 30 days. You aren't failing because you can't get ahead, you're failing because you've been tricked into carrying the bank's risk on your back while they take all the profit. Let's look at the hidden math that your real estate agent and mortgage broker conveniently forgot to mention. We are going to look at Scenario A, the standard homeowner. Imagine you buy a house for $300,000. You put 5% down, which is $15,000, and you take out a loan for $285,000 at a 7% interest rate. On paper, it looks manageable. In reality, it is a mathematical slaughter. Over 30 years, your monthly principal and interest payment is $1,896, but that's just the beginning. Over the life of that 30-year loan, the numbers look like this. Original loan amount, $285,000. Total interest paid, $397,560. Property taxes estimated at $108,000 over 30 years. Homeowner's insurance estimated at $45,000. Maintenance and repairs using the 1% rule, that's $90,000. Total cost of ownership, $925,560. By the time you make your final payment in 2056, you have paid nearly $1 million for a $300,000 asset. But it gets worse. You have to factor in the opportunity cost. If you had taken that same $15,000 down payment and the monthly difference between renting and owning and placed it in a simple index fund averaging 8%, you would have over $2 million. Instead, you have a 30-year-old house that needs a new roof and a kitchen remodel. Now, let's look at Scenario B, the truth. The truth isn't that you shouldn't have a roof over your head, it's that the 30-year term is a wealth killer. If you were to take a 15-year mortgage or aggressively prepay the principal, the numbers shift. But the bank won't push the 15-year option because they lose hundreds of thousands of dollars in interest. They want you in the danger zone because that is where the profit is maximized. Let's look at the real-world case of Tobi. Tobi is 30 years old and just bought his starter home. He feels proud. He's investing in his future. Tobi pays his mortgage every month, which includes taxes and insurance. For the first 5 years, Tobi pays roughly $113,000 to the bank. Out of that $113,000, only about $18,000 goes toward his actual principal. The other $95,000 is pure interest, gone forever. 5 years in, Toby decides to sell because he got a job offer in another state. After paying the 6% realtor commission and closing costs, Toby walks away with almost exactly what he started with. He hasn't built wealth, he's just lived in an expensive box and paid for the bank's electricity. Toby is the victim of amortization drag. He spent his most valuable compounding years paying for the privilege of debt. This is the reality for millions of people who flip houses every 5 to 7 years. They never reach the part of the curve where they actually pay down the house. They are just perpetual interest payers for the banking cartel. The reality check is this. Stop viewing your primary residence as an investment. It is a consumption item. It is a place to sleep that costs you money every single month. To beat the system, you must adopt a mercenary mindset toward housing. First, if you must buy, ignore the max qualified amount the bank gives you. They want you house poor because a desperate worker is a productive worker. Buy significantly less than you can afford. Second, understand the power of the extra payment. Because of how interest is calculated, a single extra payment made in the first year of a mortgage is worth dozens of payments made in the final years. By adding just 10% extra to your principal payment every month, you can shave nearly a decade off the loan and save over $150,000 in interest. The bank hates this. They might even try to charge you a prepayment penalty. Check your contract. Third, consider the rent-to-own ratio. If renting a similar house is 30% cheaper than the mortgage, taxes, and maintenance, then renting is the superior mathematical choice. You take that 30% and you invest it in liquid assets that don't leak or require a new roof. The goal is to minimize the interest-to-equity ratio. If you are paying more in interest than you are building in equity, you are losing. The 30-year mortgage is a scam because it exploits the human desire for stability to create a lifetime of debt servitude. It turns citizens into debt slaves who are too afraid to take risks. You are being sold the dream so that you don't notice you are being drained of your potential. Your home is not an asset if it takes money out of your pocket every month. It is a liability. The real winners in the real estate game are not the homeowners, they are the lenders. If you want to be on the winning side, you have to stop thinking like a consumer and start thinking like a math teacher. But the mortgage is only half the trap. The other half is what happens to the money you do manage to save. While you are struggling to pay down a 7% loan, the government is printing money at a rate that ensures your remaining cash loses 5 to 10% of its value every year. If you think the bank is stealing from you through interest, wait until you see how the retirement industrial complex uses inflation to ensure you can never actually stop working. The system wants you tired, tied down, and trapped. Break the chain, run the numbers, and never mistake a debt for an achievement. The middle class is being liquidated one 30-year contract at a time. The question is, are you going to be the one paying for the bank's skyscraper, or are you going to be the one who owns your life?